My name is Steve Gribben, and thank you for joining this Glassbox strategy session. As you are probably all too well aware, running a small cap company can often feel incredibly expensive. You've got legal fees, accounting fees, auditing fees, software fees, the list goes on and on. Today, I want to talk about how you can make one strategic move in almost any market sector to get ahead of your burn rate, to basically put yourself in a position where you can pay for all of those annoying fees I just mentioned from operating cash flow, instead of borrowed funds or a new equity injection. The strategy I'm talking about starts with a simple arbitrage play. As a small cap company, you are in a unique position to take advantage of the disparity in price to earnings multiples applied in the private market versus the public market. By leveraging this disparity to your advantage, you may actually be able to generate immediate positive cash flow in a 100% financed acquisition. Now, I'm going to explain exactly how you can do this. But before I do, I want to make sure that you understand what I mean when I talk about disparity in price to earnings multiples in the private market versus the public market. To be clear, you can take the exact same target company. Let's say it's got $10 million in top line revenue and $1 million in EBITDA. And it will have a widely different valuation depending on the lens from which it's being viewed. If a private market buyer is bidding on that target, let's say a family office or a wealthy individual, the value to that buyer might be $3 million to $5 million. If a public company buyer is bidding on that target, let's say a company in the same sector as the target that's attempting to make a strategic acquisition, the value to the buyer could skyrocket to over $10 million. Now, a lot of factors are going to go into valuing a company, and I'm definitely oversimplifying things here. But the point I'm trying to make is that the exact same company can have a widely different value to a buyer in the private market versus the public market. So how do you play this disparity to your advantage? As a small cap issuer, you have to seek out established cash flowing private targets valued below $10 million. These types of targets are generally too small to attract significant interest from private equity groups or other established public companies. The cost to find and transact on these companies is just way too high for private equity firms. PE firms, they have too many Ivy League managers, lawyers, consultants, a whole bunch of people to pay. And the cost for all of those people just can't be absorbed in a relatively small transaction. Search cost alone will eat a PE firm alive in a transaction of this size. Likewise, other established public companies won't seek out established cash flowing sub $10 million acquisitions. If a pubco seeks out a company at this level, it's usually to acquire a technology or some other asset that has exponential growth potential. They're not going to be looking for cash flow play at this level. So as a result, with PE firms out of the picture and other larger pubcos out of the picture, your competing suitors are limited, and you'll be left with an opportunity to bid on one of these types of targets at an attractive price to earnings multiple. And once you make this type of acquisition, you stand to be rewarded handsomely as an OTC or entry-level exchange-traded company. The OTC QB marketplace, for example, typically generates a very ambitious price to earnings multiple for companies with any sort of cash flow, with the market figuring that this cash flow suggests some sort of proof of concept and that there is much more market share to be had. So just by closing on a sub $10 million acquisition and then adding revenue and a modest amount of cash flow, you will be able to quickly amplify the market cap of your entire company. This will give you plenty of room to either finance your acquisition or use your stock as a currency for your acquisition under a structure that ultimately drops a significant percentage of the target's pre-acquisition cash flow to your bottom line. To take this whole concept a step further, if you focus on making a modest private company acquisition early in the life cycle of your public company, you may have a better chance of executing your overall business plan in the long term. Simply by putting in place a steady stream of income that can be used to cover your basic expenses associated with being public before those expenses become too big of an albatross around your neck. I know this may sound painfully obvious, but very few companies actually follow through with this type of arbitrage for cash flow strategy. And I think it's because they fail to really quantify how expensive it is to operate as a public company before they grind through the first few years of operation. So here's a few tips on how you can chart a smarter path than the rest of the pack. Think about working with a broker or investment banker that can source the type of established cash flowing acquisition opportunities I've discussed within your sector. You can often find brokers willing to work on success fees alone. Number 2, speak to your attorney about the various ways you might be able to use your stock as a currency to help reduce the equity and/or debt you might have to raise to complete your next acquisition. And number 3, talk to your CFO and your investment bankers about the possibility of using an interest-only financing product for your next acquisition. These types of products can often be refinanced out at a later date and take advantage of the increase in your market cap. If you'd like to speak more about specific opportunities that you're reviewing right now or these concepts in general, please feel free to reach out to me. I can be reached via email at info@glassboxlaw.com, or you can fill out one of the inquiry forms on our website at glassboxlaw.com. Thank you very much.